Hello friends, we'll be discussing another illustration which is related to ratio analysis. Now that we are on the 7th problem on ratio analysis, we'll understand how to solve or how to go ahead with the solvency and insolvency ratio. Basically using or rather providing a question which will have you to comment on the financial conditions. Using this parameter itself, we'll go ahead and start with this illustration. So let's start with one. So the illustration has been mentioned down here. Let's read it out for you. There is a summarized balance sheet of a concern for 31st of December, and it states the liability and the asset side together with certain more informations related to it. Let's read out the liability side first. We have 6% preference share capital amounting to 1,50,000. We have equity share capital amounting to 2,50,000. General reserve and profit and loss account, general reserve being 20,000. Profit and loss account being 15,000 here. 5% debentures, which is again a long-term debt amounting to 1 lakh. Sundry creditors at 28,000. Bills payable at 12,000. The total of the liability side being 5,75,000 here. On the asset side, we have goodwill worth rupees 20,000. We have land and building worth rupees 2,50,000 here. Machinery is 1,75,000. Furniture being 10,000 and stock being 90,000 as mentioned. Sundry debtors being 21,000. Cash at bank being 5,000 and preliminary expenses is 4,000 respectively. Apart from that, in the note below there, they have mentioned that the sales amounted to 4 lakh rupees, out of which 20% is made on credit. That means out of 4 lakh, 20% has been made on credit, rest everything is on cash. Gross profit and net profit after tax is 80,000. That is, gross profit after tax is 80,000, net profit after tax is 20,000. We have to go ahead and comment on the financial conditions. That means all the ratios that are related to the financial conditions will be mentioned down here. So to start with, we'll have the working note done first, which will have like current assets, total current liabilities, etc. Let's start with the current asset part. So the total of current asset is 1,16,000, where we have included stock, debtor and cash. The total of that compromises, or rather the total of that gives you the basic structure of current account. The next phase is liquid assets. Liquid as in only cash or near to cash items, which are only either the cash balance and the debtor balance. So the total of that comes to 26,000. The next will be the current liabilities part. So the total of current liabilities part is 40,000 again, which includes creditors and bills payable. The next phase is fixed asset, which has land and building. Next is machinery and furniture. The total of that being 4,35,000. The next item that we'll be figuring out is the proprietary fund. Again, the next item that we have figured out is proprietary fund, which has equity share capital, preference share capital, reserves and surplus, profit and loss account. The total comes to 4,35,000 again. The next item that we have figured out is the total debt. That includes the 5% debentures and the current liabilities. Total comes to 1,40,000. So the next item that we're dealing with, shareholders equity. This formula is proprietors fund minus shareholders capital, and that will only include preference equity capital. Now when it comes to proprietors equity that we have to figure out, proprietor fund, out of that you have to subtract the total amount, or rather this will be the net proprietor fund that we exactly have to find out. So the net proprietor fund here is proprietor fund minus goodwill minus preliminary expenses. So the total or the net proprietor fund is equal to 4,11,000 minus 1,50,000 being the preference share capital. So the shareholders, or rather when we talk about the ratio that we have to calculate, or the shareholders equity that you have to calculate, that is 4,11,000 minus preference share capital, which is 1,50,000. That will give you the total. So the shareholders equity has been mentioned as 2,61,000, and the last part that we'll be calculating is total assets. So now total assets is equal to 5,51,000. With this we have completed the working note. Let's start with the actual problem, which relates to the finding of all financial ratios. So the first ratio that we'll be starting with is the current ratio. So the formula for current ratio is current assets upon current liabilities. We already have the value. Let's paste that here. So the current ratio is 2.9:1. The next one that we'll be figuring it out is the liquid ratio. Now, when it comes to liquid ratio, the formula is liquid assets upon current liability. Liquid asset total also we have figured out, so we'll put that value here. So liquid ratio here is 0.65 is to 1. The next ratio that we'll be dealing with is a proprietary ratio. The formula for that is net proprietary fund upon total assets. Both the values we have already evaluated. So the proprietary ratio is 0.75 as per the calculations. Now the next ratio we'll be dealing with is fixed asset to proprietary fund ratio. That means fixed asset upon proprietary fund. So the values are 4,35,000 divided by 4,01,000. So the proprietary or rather fixed asset to proprietary ratio is 1.06. Now the next ratio that we'll be dealing with is debt upon equity ratio. That means total debt upon total equity or rather proprietor's equity. So that comes to 0.34 is to 1. That is the debt equity ratio. The next ratio that we'll be dealing with is the capital gearing ratio. The formula for this is equity share capital divided by preference shares plus debentures. So the capital gearing ratio that we figured out is 1 is to 1. Now the next ratio is gross profit ratio. The formula is gross profit upon sales. We already have the figures for gross profit and net profit, so we can easily use those values. So the gross profit has been also calculated as 20%. Let's figure out the net profit ratio now. The formula stays as net profit upon sales into 100. Net profit value being 20,000, sales value being 4 lakh. You multiply it by 100 and you get the format or you get the ratio in a percentage format. So the net profit ratio that we have calculated here is 5%. Now the next ratio that we'll be dealing with is the stock turnover ratio. So the formula is cost of goods sold upon average stock. Now how to figure out the cost of goods sold? They have already mentioned that the sale value was 4 lakh. However, the 80% sale was made on cash and rest 20% on credit. So whatever has been made in cash, that is the value of the cost of goods sold. So for 4 lakh, if you multiply it by 80%, that will give you a value of 3,20,000. Now when it comes to average stock, that is opening plus closing divided by 2. However, we don't have any such details. So the closing stock value that has been provided into the balance sheet is the value itself that you are supposed to take here, that is 90,000. So the stock turnover ratio is 3.6 times. The next ratio that we'll be dealing with is the debtor turnover ratio. The formula is debtor upon credit sale into 365. Now we know that out of 4 lakh, if 3,20,000 refers to cash sale, then the rest 20,000 will refer to the credit sale, or rather the rest 80,000 will refer to the credit sale here. So that amount is supposed to be taken, and the debtor amount is already available in the balance sheet. That has to be multiplied with 365 days, because when you calculate the turnover ratio, that means you're calculating this in number of days. What is the credit period, or rather what is the credit period that you can allow or that you can receive? So the debtor turnover ratio comes around to 96 days. That means the debtor has to pay up the balance within 96 days. That's an average credit period that can be provided to any debtor. The next ratio that we'll be dealing with is return on proprietor's fund. The formula is net profit after tax upon proprietor fund. Both the values are already available with us. So the ratio is 0.05 is to 1. The last ratio that we'll be dealing with is turnover to fixed asset ratio. That means the formula remains the same: sales upon fixed asset or turnover upon fixed asset. Please note, while taking the turnover here, you have to take both the cash and credit sale. So the ratio is turnover to fixed asset comes around at 0.92 is to 1. So with this, we mark the closure of this specific sum. I hope you have understood all the financial ratios that can be dealt with this specific illustration. So thank you for watching this video. Stay tuned with Ekeeda and keep subscribing to Ekeeda.